Hey everyone, me Kevin here. On Tuesday, September 15th, 2020, there is a company that is coming with a lot of hype that is IPOing, and folks, it is bound to get insane media attention. The company is called Snowflake. They're a cloud-based software that builds on top of Google, Microsoft, and Amazon's database and web services so that companies can run near real-time analytics to understand their customers better. And I know that's a mouthful, and that's why I'm making a video on it, because I had trouble understanding what the heck it is that they do first. But don't worry, I spent the last 6 to 7 hours understanding as much as I could about Snowflake, and let me tell you, I am just scratching the surface. So this is more of sort of my first impressions on this company. So take it for what it is, and also take the free $20 that M1 Finance will give you for signing up for investing with M1 Finance. You deposit $100 and you get $20 for free. Heck, you could take the money away if you want afterwards. All right, let's get into what I found out. So first, Snowflake's IPO, or the day that it shows up on the stock market, is Tuesday. That means you could potentially buy Snowflake stock on Tuesday. It's expected to open at a price of between $75 to $85, though oftentimes these IPOs purposely try to price a little low, and then they end up popping right up to $100 per share. So it wouldn't surprise me to see them say, oh yeah, we're gonna list it for $75 to $85, only for it to actually be selling somewhere in the $90 to $100 range. We'll see. But the expectation is there's going to be a lot of hype around this, mostly because we've got Warren Buffett's Berkshire Hathaway that has invested $250 million in the company, alongside Mark Benioff's Salesforce, who also invested $250 million into the company, which one of these is actually a really big surprise. See, Warren Buffett is an investor who has made a rule of not investing in money-losing companies. And folks, Snowflake is exactly a money-losing company. And this got me very, very interested. Why the heck would Warren Buffett be investing in a company that is losing money and breaking his rule? Well, it's partially because they're growing like crazy. In fact, here is some of their earnings literature showing their growth in earnings over just the last quarters. Folks, these are quarters. These are not years. So look at the bottom here. Quarter 3, 2019, they had $29 million of revenue. Now, in quarter 2, 2021, which they do their quarters funny, okay? That's like July 31st, 2020. But anyway, they're at like $133 million, which is crazy, crazy growth. And not only are they growing like crazy, but they also boast this really cool thing called positive net retention. And that basically means that you're not losing customers. Like a number under 100% would mean you're losing customers. So if, let's say, you had 10 customers and you had 90% retention, that means you're left with 9 customers. Well, because they have a positive figure, it actually means they're earning more money from every single customer that they have, with a net retention that is positive over 100. That is at 158%. And they've got 56 clients that pay over $1 million in revenue per year. And they are spread out to about 3,117 customers, which they expect to grow dramatically. And they are spending dramatically to try to make that growth happen as well, which, trust me, is gonna be something that we talk about. So first, what the heck does this company even do? Like, I gave it a tiny intro at the beginning, but let's be real. What does this company do? So a lot of what I was doing was trying to figure out what the heck it does. The way I could best explain it is this. You know what a spreadsheet looks like, right? Like an Excel spreadsheet, something like, Google spreadsheets, or even, here, a spreadsheet that looks much like this. See, it's a spreadsheet. And I could put data in here like 100, 105, 200, whatever. And I could do fun little things like, oh, hey, iPad here. Why don't you tell me what the average of all that is? Oh, 135. Cool. That was awesome and fast. I like that. Well, imagine if you could do those sort of calculations that fast, except not just on 3 pieces of data, but on much, much more. In fact, have you ever, maybe some of you have you ever seen like large spreadsheets, maybe in school or maybe for your business? Like maybe you've got an email list of like 1,000 email addresses or 10,000 email addresses. Heck, I've played with these spreadsheets, and let me tell you, the computers start slowing down. You start getting the pinwheel pretty fast, even just at like 10,000 entries on a spreadsheet. Well, Now, instead of thinking in the neighborhood of tens of thousands, or 3 like it just showed you, let's not even think in the neighborhood of hundreds of thousands of data points, or millions, or hundreds of millions of data points on a spreadsheet. Instead, imagine a spreadsheet that is like 1 billion data points long. 1 billion data points! That's an insane amount of data. Now, imagine you being able to push average on 1 billion points of data, and it gives you the answer pretty dang quickly. Well, that's the goal of Snowflake. And it's not just to tell you averages, it's really to let companies access their own data and then run tests and comparisons and traces and linkages between different sets of data seamlessly. So that way it makes it very easy for them to make business decisions and business conclusions, all without messing up the core data. See, one of the big things they boast is having centralized data points that everybody else can then work on and run conclusions on without messing up that original spreadsheet, so to speak. So you can have hundreds of remote workers working at, let's say, Nike, and they could all be running different Snowflake analyses on the main data in sort of the middle that the company has collected, and they can all come up with their own conclusions and then try to advise business leaders or their marketing departments or whatever. The best example that I could actually find, like the best real example that I could find, was an example that Snowflake gave in their marketing. And honestly, I don't think it's the best example that they could have used, but here's what they did. They went ahead and said, okay, well, hey, here's a sample of data from City Bike. You know, those bikes you can rent around New York City or whatever. And what they did is they found, oh, okay, so we have a ton of data on every single ride, the length, the duration, the time of day, the date, everything. And all of a sudden around February, 13, 14, and 15 in a given year, they found that their rides had like plummeted and then they went right back up. And so within a few clicks, they were able to merge a few different spreadsheets that they had. Essentially, I'm calling them spreadsheets. They call them other fancy things, but I'm simplifying here. And they're able to say, oh, okay, well, it looks like our average rider is somewhere between 28 and 35 years old. Maybe somebody who works at, some of the companies that are in New York. So, kind of this millennial aged worker. And, interesting. On the 13th, 14th, and 15th, we had snow. All right, so maybe that's why ridership declined. And now here I am thinking to myself, come on, like I could have just picked up the New York Times that day and told you that same thing. Like I didn't need all of that to do that. But then again, here I am, just a single person business. That is very different from, let's take for example, Apple. See, Fortune 500 companies, not individual people like me, are loving this. Forget bikes for a moment, forget about me for a moment. Think about Apple. What kind of data does Apple have? Well, they track the location of pretty much everything that you own. They know how much you're using their devices. Heck, here's an iPad, here's a Mac Pro right here, there's an iMac. They got a lot of angles on me, okay? They even know what my heart rate is. Thanks, Mr. Apple Watch, and apparently I'm on power reserve for battery. And now they even have your credit card data. Well, that is, of course, if you sign up for the Apple Card. Not that I'm an Apple fanboy or anything, not sure what would make you think that, but they're even in our cars as CarPlay. Apple is literally everywhere. And every single one of these interactions creates more and more and more data. And if we can give companies like Apple all that data, well, first, I guess we should probably be scratching our heads about privacy, but Apple, as a business user, and me putting my investor hat on, not my privacy hat on, says, Apple could probably do some powerful things with that data. Imagine being able to correlate all bunches of things like Apple mobility, like, it's February 28th and less people are going out all of a sudden. They're spending more time online and they're not going to their office like they usually are. In fact, they're not even logging onto their office computers anymore. They're staying home. Oh, people are spending less on their credit card and they're saving more and they're paying off more debt. February 28th. Oh, that was right before the pandemic. Now, no guarantees. I just made up that example, but I imagine that these are the sorts of things that data analysts can collect. Now, I'm just some dude on YouTube, but there's a reason why Apple has job listings specifically for Apple Snowflake engineers. In fact, here it is. And I mean, I have to say, I was blown away myself. This job was posted on July 10th, so they've been hiring Well, either they haven't filled that job or they've been hiring for a while. But according to Glassdoor, Apple and other companies are paying these sorts of employees somewhere around $130,000 to $170,000 just to use the Snowflake infrastructure and then presumably make some sorts of conclusions from the information here. Now, the takeaway from this to me is, wow, I can't believe that these big companies are actually hiring people to specifically work on that one platform. But believe it, it's happening. And when you look up Snowflake jobs, you see more and more of that. Okay, so I'm impressed. But what about the financials of this company? Well, this is where things get funny. And as an investor, this is what matters most to me. See, this company spends an insane amount of money on marketing. And there's nothing that screams really high ROI for marketing dollars like IPOing. Last fiscal year, this company spent more money on marketing than they had in sales. And the same was true for the year before that. That is, the company is literally, if you think of sort of an input-output box from third grade, imagine the teacher putting on the board, hey everyone, here's a company that puts $1 in this box, and at the other end comes 50 cents. Ooh, I don't like the divide by 2 input-output box. I like the multiply by 2 or 10 box. Well, that's their hope. Their hope is that the $1 they're putting in now and only getting 50 cents out will in the future grow to end up being $10. It's kind of like a delayed input-output machine. After all, remember that revenue retention growth they're seeing. And 26% of Snowflake's revenue comes from Fortune 500 companies. Once Fortune 500 companies start loving Snowflake, they might continue hiring people and using the product more and more and more. And the more people use the product, the more money they make. It's very simple. So when it comes to cash and debt, this company also has enough cash and accounts receivables to basically wipe out their entire debt. So debt's not really a problem. Snowflake does have some competition though. Amazon has a service called Redshift and Google has one called BigQuery. And both of these, or all three of these, seem to be strong at their own individual tasks. So it wouldn't be a surprise to start seeing companies like Apple or these other larger companies probably use all three of these services and use them all to their own strengths. And that makes sense because despite this competition that already exists, especially with Amazon and Google, which are big names, Snowflake's growth has been impressive. Now, some say this is partially because they believe Snowflake does things better, faster, and easier than other companies. And that might be true, but as some dude making a YouTube video, I got no clue. All I can tell you is it's very difficult to value a money-losing company. So I'm gonna go ahead and try to do the very difficult and value a money-losing company, which is just insane. But we'll go ahead and try and we'll draw some quick conclusions here. Okay, so I transferred some of their data from fiscal year 2019, which honestly is really 2018, and fiscal year 2020, which is realistically 2019 plus, well, January. It's a silly year thing that they did. It's silly. Like we're in 2021 now, according to them, which maybe they're just trying to get out of the pandemic. Okay, maybe I can't blame them for that. But anyway, if you look at this growth, it is impressive. I mean, they went from 96 million in revenue to 264 million in revenue. That's insane growth. I mean, that's 2.5x, right? That's awesome. Good for them. And maybe they'll even be able to sustain some of this, momentum. We'll see. Now, and that's always the big question mark with growth companies, right? Then we've got cost of revenue here, which is actually becoming less expensive. They've only spent about 44% of their revenue on costs of revenue. Then they've got marketing and our research and development and general and administration expenses. And this is normal. The good news is that their R&D expenses are falling and their general administration expenses right now are staying stable, but it wouldn't be a surprise to see both of these decline as their revenue starts exponentially growing. That's usually what happens. The concern is that they have to keep pushing out marketing dollars. Right now, they're pushing out, well, at least last year, they pushed out 110% on marketing compared to revenue. That is, their revenue was $264 million, and they spent $293 million. That doesn't sound like a good business model so far. The same the year before. They made 96 mil, but they spent 125 just on marketing. And then they still had all these other costs. So the company's been losing money, okay? But again, normal with these growth companies. They come up with an idea and they're like, let's spend every waking penny we have on marketing. And you know what? Let's borrow more money. Except they don't actually have a lot of debt. It's kind of interesting. Where they're getting the money from. Obviously, some form of investors into the company is what's bringing the money in. But anyway, their net losses, those have skyrocketed as well. But let's go ahead and now move forward to looking at their most recent data. Here's their most recent data, and I want to show you this separately because then you get to start identifying some trends. Look at this. Their most recent data ending July 31st, 2020 shows that their cost of revenue has declined. Look at this. They used to be at 53%, then 44%. Now, on a half-year basis, they're down to 38%. That's a really good decline. That's good. We want to see that go down. We want to see this top line go up, and we want to see the other numbers go down. This going down is good. Marketing as a percentage of revenue, look at that. It is under 100%, and it still grew. Because remember, and this might be confusing here for a moment, so I want to clarify it, this represents 6 months. These represent 12 months. So they made almost as much money in 6 months as they did the entire year before that. So all of the numbers that you're going to see here are the last 6 months. Okay, so they're spending less, but actually they're making more. I mean, look at this. They spent 190 mil on marketing, which is almost 100 mil less than they did the prior year. They spent 190 in 6 months though. Remember, it's 6 months. But they almost matched the revenue. That's incredible growth. And this is where we want to see the ratios start declining to. And then we also saw, look at this, general and admin as a percentage of revenue, way down. R&D, way down. Good, that's what we want. We want those percentages to be down. Closer to like 10 to 15% would be nice. Okay, then we've got a little bit of tax expense and net and things like that. Okay, cool. So we get to the bottom line here. Now, they're going to have some tax benefits left over for all the losses they've had here for a while, is at least my assumption that they're going to have some loss carryover. So I'm going to simplify this, and I'm not going to focus on taxes right now or interests or other expenses. All I want to do is see how much does this company have to grow for the next 2 years to actually make sense. And so that's what I'm doing over here. So what I did is I took the last numbers ending July 31st, and I multiplied them at a 150% growth rate for 2 years. That literally means if you have $10, turning $10 into, well, 250 or 2.5 rather, $10 times 2.5 is $25, times 2.5 again is $62.50. So we have to see $10 grow into $62.50. That represents a 150% growth rate compounded for 2 years. Okay, that's a lot of growth. It's more than doubling. It's 2.5xing, right? And you can see that here. What you could do to just fact check me on that really quick is just take this 241 and go times 2.5 times 2.5. And you end up getting $1.5 billion in revenue. If they can make $1.5 billion in revenue, and we can get the cost of revenue down to 30% because we're on the declining trend, then they'll have a gross profit of around $1 billion. Okay, that's simple. I got that. Okay, here's the kicker though. I cut their marketing more than in half, and there's a reason why I had to do this. You'll see why I had to do this, because so far this sounds insane. Like, why, Kevin, are you assuming that they have to grow 2.5x next year and the year thereafter? Well, you're about to find out. Okay, then I cut their marketing way down to 35%, and yet somehow they still have to see that sort of insane growth. Okay, then I took their research and development and their general and admin, and I pegged them at 15% of revenue. Okay, that's probably where it should be longer term. Could go down to 10%. I put it down at 15%. Whatever. We'll see. We'll play with these numbers in a moment. Then I just left some generics in here like other and interest and things like that and taxes. Okay, big deal. All right, so now we get to a net. This company would actually create some net profit. And that would be its first net profit of somewhere around $85 million for the first time in a 6-month period. Remember, this represents 6 months. We're going to annualize this now in just a moment. There are 278 million shares outstanding. And if I divide these two and then double them to annualize it to make it an annual figure, I get to an earnings per share of about 61 cents. So with all this growth that we have to require, we're only going to make 61 cents per share. And if this company, with all this growth, has a price to earnings ratio of 100, then the company is worth $61 a share. Yeah, wait, but I said they were going to IPO for $75 to $85. Yes, that's because there is an insane amount of growth built into this company's projected share price, in my opinion. Now, I'm no, expert here, but I'm trying to understand this stock and understand the potential valuation. Let me do this. Let me bring you over to the actual stock page itself, or not the stock page itself, but rather the spreadsheet itself. Let's go ahead and change some of those things that we were just playing with. Let's go ahead and say, we'll leave it at a PE ratio of 100, but let's go ahead and try to make this company actually show us some real growth in the stock price. Like, what are we gonna have to see? Well, let's assume they spend less money on research and development and general and admin. Let's drop this to 10% each. Well, if I drop each of those to 10% of revenue, then all of a sudden, this share, or the value of this company per share at a 100 times earnings multiple, which is very rich. Salesforce is at like 95. That's why I'm using this, because this is going to be a growth company for probably a decade to come before we start valuing it like a Microsoft or something, or an Apple at like 30 to 40. Then it's reasonable that this share price could be somewhere around $169 per share, with 278 million shares outstanding. So, if you are buying Snowflake, or you are thinking about buying Snowflake, know that you are buying into massive growth potential, and you're buying into massive growth hope. Those are two different things, right? Because if the potential misses, the stock price could get hammered strongly. Now, here's the other thing to know about this, and potentially when it makes sense to buy this stock. Right now, when this stock comes out, when it IPOs, there are only going to be about 28 to 32 million shares available, which that sounds like, seriously, Kevin, like 28 to 32 million shares? That sounds like a lot of shares. Yes, there are a lot of true shares, and this is very, very true. However, between about November 26th and December 6th, they're going to release potentially up to another 11.2 million shares, which means you literally go from, I guess I just broke my whiteboard, but we'll use it anyway. You literally go from 32 million shares outstanding to adding another about 11 point, what did we say, 2? So that's going to be somewhere around 43.2 shares, potentially. I mean, if those people all sell out who have those shares. Okay, so you get some basically dilution happening in November to December. But wait, 15 days after this, as long as the stock has been, or the share price has been trading for 33% more than what it came out for, in other words, if it IPOs for somewhere between $75 to $85, then as long as it trades for somewhere between $100 to $113 for at least 10 days out of the 15 days after November 26th and December 6th. Yeah, go ahead and rewind like 10 seconds to listen to that again if you want to. Sorry. If that happens, okay, here's the kicker. It is possible that people who have control of 38 million more shares will be able to sell. Now, this does not mean that they will, but if all of these people decide, dude, I just got a fat pay raise and I'm going to Tahiti, I don't care about the pandemic, I am retiring. Wherever you want to retire, okay, doesn't matter. Fine, and then they sell. Well, look at how many shares we have available now. We go from 32 million on IPO day to potentially 11.2, well, let's see here, 11.2 plus 32 plus 38 equals 81.2 million shares. 1.2 million shares by probably somewhere around the middle of December. So it's like a Christmas present. And then sometime in January, if there are any other restrictions on anybody else's shares, any other kind of lockups, well, those expire after the second day or on the second day after their second public earnings report. Yeah, complicated, I know. But the point is, there might be some rationale, and I'm not telling you to do this because look, IPO stocks can be nuts. This stock could literally hit the market for 75 bucks and it could end up sitting at $100 the same day. It could end up sitting at $150 the same day because that's just the way the market works. Seems pretty irrational sometimes. A lot of growth baked into that, but people are so enamored with big data right now that it could happen. And if that happens, great, you make some big profit unless you're the person who's buying in at $100 or $150 a share. You better be in it for the long haul is what I would say in those prices. And that's not to say it can't go up, but let's say over the next 2 quarters, they continue to smash earnings. We see that 2.5xing in revenue, which that'd be cool, but I guess we'll have to see on that one. And they cut their marketing budget. Okay, great. Let's say all of those things happen. I still can't help but think there might be a better opportunity to buy this company between November 26th and maybe somewhere around, let's say Christmas time, December 25, somewhere around there, in that range, because there were some complicated timeframes there. In my opinion, this is when this company is not going to have all of the, oh my gosh, Warren Buffett invested in this IPO hype. That hype, in my opinion, is potentially very, very risky. Now, am I going to be looking at this stock the day it IPOs? Probably. Do I think any of us should buy it? I think you should make up your own decision on whether or not you should buy it. Me personally, I'm probably going to sit this one out. And that might be a big mistake because I do think that there's a lot of long-term real value in this company. I think big data is a big play. But that kind of volatility is too much for me to handle. I don't like stress. So I am not saying no because I think it's a bad deal or I think it needs an insane amount of growth. I'm simply saying it is going to be way too stressful for me to be a part of. With that said, I think I might be able to have some eggnog and actually buy this stock when there's some snowflakes in the air. Because right now, the only thing I've got in the air are ashes, because I live in California, and it sucks. Just a quick note, if for some reason the stock crashes, let's say it IPOs for $75 and it goes down a good chunk, I might be more tempted to buy it then. I do think it's valued very richly, but I do like the long-run growth prospects for it. But again, I'd potentially rather wait for some of the dilution to pass. And let me see if they can actually consistently keep their marketing costs going down while growing. That's the trend we want to see continue. A little bit too early for me. That might mean I'm missing out, but that's okay. I won't have FOMO about it. Thanks. Well, there you have it, folks. If you like this breakdown, please consider sharing it with anybody who's interested in Snowflake. And remember, this is just a general overview. It's me scratching the surface on Snowflake. I don't know everything there is to know about Snowflake. I have a lot more work to do on this company, but honestly, with these lockup periods, I think I've got some time. I'm gonna, cheers. Oh wait, this is water. All right, we'll see you next time. Please consider subscribing and, well,